$47,000. That's the difference between choosing an index fund and choosing the wrong mutual fund. On the exact same $10,000 investment over 30 years, one grows to roughly $57,000. The other, $10,000, quietly becomes about $32,000. Same market, same time frame, wildly different outcome. Let's talk about why. Let me introduce you to two people. Both are 25 years old. Both have $10,000 to invest. Both are nervous first-timers who just want their money to grow. Alex opens a brokerage account and picks a popular, actively managed mutual fund. It has a strong recent track record. The fund manager is on TV a lot. It feels safe, professional. Jordan does a bit of reading, picks a plain vanilla S&P 500 index fund. No fancy manager, no exciting pitches, just the market. 30 years later, both retire at 55. Jordan's $10,000 has grown to approximately $57,000. Not because Jordan was clever, not because Jordan picked winning stocks, just because the market averaged around 7% annually and Jordan didn't pay someone to get in the way of that. Alex's $10,000? It grew to about $32,000. The market did the same work, but a 1.2% annual fee, compounded over 30 years, quietly consumed $25,000 of Alex's returns. $25,000 gone. Not to a market crash, not to a bad stock pick, to a fee that Alex never truly understood. Today, you're going to understand it, and by the end of this video, you'll know exactly which one Alex should have chosen and what to do about it yourself. But before we get to the verdict, you need to understand how each of these actually works. All right, let's start from zero. An index fund is a type of investment that tracks a specific market index, like the S&P 500, which is a list of 500 of the biggest companies. Apple, Microsoft, Amazon, Google, all in one. Here's the analogy I want you to remember. An index fund is like buying the entire buffet. Instead of guessing which dish is going to be the best, you just get everything. Some dishes underperform, some are incredible, but on average, the buffet performs pretty well. And historically, that average beats most individual stock pickers. The key word here is passive.
Nobody is actively deciding what to buy or sell. The fund simply mirrors the market automatically. And because nobody is actively managing it, nobody's salary needs to come out of your returns. That's why index funds are so cheap. Some of them charge as little as 0.03% per year. That's about $3 per year on a $10,000 investment. Remember that number. Now, a mutual fund is also a pooled investment, but here's the key difference. It's actively managed. There's a person or a team making decisions every day. What to buy, what to sell, when to enter, when to exit. Here's the analogy. A mutual fund is like hiring a personal chef. They decide what you eat every night. The chef might be great, or they might not be. But here's the important part. You pay the chef no matter what. You pay whether the food is amazing or terrible. You pay whether you made money or lost money every single year. And that's where things start to get expensive. Let's break down the fees. Fee number one, the expense ratio. This is the yearly percentage the fund takes from your investment. And here's the problem, it's silent. You don't see it leave your account. It just reduces your returns in the background. The average mutual fund expense ratio ranges from about 0.7% to 1.25%. Compare that to 0.03% for an index fund. On $50,000 invested, that's about $15 per year for an index fund, or up to $625 per year for a mutual fund. Same money, completely different cost. Now let's talk about load fees. Some mutual funds charge you just to invest. A front-end load of 5% means if you invest $10,000, only $9,500 actually gets invested. $500 is gone immediately, before you earn a single dollar. And then there's the third fee, the one almost nobody talks about, the 12B1 fee. This is a marketing fee. Yes, you are paying the fund to advertise itself to other people. It's usually around 0.25% to 1% per year. Stack that on top of the expense ratio and suddenly your small fees aren't so small anymore. Over 30 years, these fees can cost you tens of thousands of dollars, in some cases over $60,000. That's the fee monster, and it compounds just like your investments do.
Now, here's the big question. If you're paying all these fees, are you at least getting better performance? Short answer, usually not. Data from long-term studies shows that most actively managed funds fail to beat the market. Over 15 years, around 90% of them underperform simple index funds. Even professionals with teams, research, and massive resources struggle to consistently beat the market. And here's the real problem. Even if a manager beats the market by 1%, a 1.2% fee wipes that out completely. So you're taking more risk, paying more money, and still ending up behind. So ask yourself this, if professionals can't consistently beat the market, what are the chances you'll pick the few that can? Let's make this simple. If you're a beginner, you don't want to spend hours researching stocks, you just want your money to grow over time, then index funds are the better choice. Not because mutual funds are scams, but because the math doesn't work in your favor. Lower fees, better long-term performance, less stress. Here's the simple playbook. Open an account with a low-cost broker, choose a broad market index fund, invest consistently, and leave it alone for 20 to 30 years. That's it. That's the strategy most people need. Are there exceptions? Yes. Some retirement accounts only offer mutual funds. Some target date funds use them. But even then, always check the fees, because fees compound. And over time, they can cost you more than you think. If this helped you understand investing a little better, hit subscribe. I'll break down more concepts like this step by step. No hype, no noise, just clear financial education. And if you know someone who's paying high fees without realizing it, send this to them. It might save them thousands. I'll see you in the next one.